Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us is Steve Wyett, chief investment strategist at Nasdaq listed BOK Financial. Steve, it's great to see you as always. Welcome back to Trade Talks.
Hi, Jill. Glad to be with you. Thank you.
You recently released the BOK Financial 2021 third quarter update. What was the most important theme in the report?
I think the most important thing, Jill, is we remain optimistic on the economy continuing to grow from this point forward. Obviously, we just saw third quarter GDP, at least in its first release, at 2%, significantly less than what we were thinking even 6 weeks ago. But we think we tie that to the bump in the number of COVID-19 cases caused by the Delta variant. As that changes and as we shift into the fourth quarter and look into 2022, our outlook remains optimistic on growth and corporate earnings as we move forward.
And what do you see unfolding for the rest of the year?
Yeah, so I think there's a couple of things that are going to be really important for us. We know about the supply chain issues, seeing some of those being able to be resolved. We think the labor market holds a key part to whether or not that's going to occur. But as we move through October, November, December, and we get the employment data out this Friday, it's going to be really important to see that improvement in the labor force, getting people back into the work environment, helping with our outlook for growth going into next year, and then actually leading to some ability to untangle some of those supply chains and actually reduce inflationary pressures as we move forward.
And tomorrow, Wednesday, November 3rd, the Fed is expected to announce an end to the bond buying program. What do you think this will mean for the economy?
Well, look, at its base, we think the Fed needs to start tapering. And on just a macro level, it doesn't make a whole lot of sense for the Fed to be continuing to throw $120 billion of liquidity into a supply-constrained economy. So having them move in this direction could actually be additive to helping supply catch up with demand a little bit forward. Now, as far as the market goes, you can never be completely certain that there isn't some leverage strategy that's tied to the Fed's quantitative easing program that could have some difficulty. But overall, we don't think that there's going to be any problem with the Treasury's ability to sell the Treasuries that they've got to finance the deficit going forward. This has been well communicated from the Fed, and so the risks that we see to the market are muted at this point.
What kind of role does the labor market play, and are you concerned about people not getting back to work?
Yeah, it's the $64 question for us, and there's just so many moving parts. Our last conversation, when we talked about this, we were anticipating an improving labor market, but we had enhanced unemployment benefits. We were in the middle of the pandemic. As that's unwound, we anticipate that that's going to improve. Now, we've thrown another wrench in the works a little bit with the vaccine mandates, and that's getting a lot of headlines as far as what that means from the labor force in different parts of the economy. But last month, personal incomes were down 1% as the federal unemployment benefits ended. We think that that's going to act as a little bit of a spur for people to get back into the labor market. Look for non-farm payroll to be much better October, November, December than what it's been for the last couple of months.
Right. And as we sit here, major averages are trading at their all-time highs. What's your view on the value of the market today with this backdrop?
Yeah, well, nobody would say stocks are cheap, but relative to other asset classes, they continue to not be egregiously expensive. And in fact, if we look at valuations just from a PE multiple standpoint, they've been coming down, obviously not because the averages are falling, but because earnings are going up faster than stock prices. So still looking for strong earnings growth. The second derivative, as we get into 2022, we're not going to see earnings grow as fast, but we're still looking for better earnings growth in 2022. And as a result, within our portfolios, we retain a bit of a risk bias. That is an overweight to equities and an underweight to cash and fixed income as we think about how we want to be positioned going forward.
All right, Steve, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.
Jill, thank you. Appreciate it.